Welcome to another session of personal finance training. Today we're going to talk about credit card as we did before. Like, share, subscribe. And this is presented by Accounting Lecturer. Okay, so let's look at credit card and debt.
A credit card is essentially a physical card that entitles the holder to borrow money from the issuer. Credit cards are a type of unsecured personal loan between the credit card issuer and the credit card holder. Typically, a credit card is used at the point of sale as a means of paying the seller for goods or services in lieu of payment by cash or check. Because of their ease of use, credit cards have become one of the most popular payment methods in the United States. Credit card companies have standard terms for their loan agreements with customers. Frequently, an annual fee is charged for the use of the card. Interest is charged for any outstanding balance at the end of the charge cycle, which is usually 1 month, although not necessarily corresponding to the calendar month. Most credit cards have an upper limit, determined by the customer's creditworthiness. Finally, since credit cards are a form of unsecured credit, they are riskier loans for financial institutions, so their interest rates are normally considerably higher than other types of loans. Credit cards are issued by financial institutions such as banks, but may also be issued by retailers and oil companies for store-specific use. General-purpose credit cards, such as Visa and MasterCard, have been around since the 1950s, when technology advancements made efficient management of the entire payment and collection process possible for the credit card issuers.
Now, we spoke about this before in terms of credit card and debt management. Now, here we have a scenario where the debt is going to be financed by credit card, and we have the APR here at 18%. So 18%, and we have a debt level of $8,000. Now, you might be wondering, why would a debt level of $8,000 be on a credit card? Which is a substantial amount. In recent times, credit card companies are happy to give higher balance amounts, and so it's not inconceivable to have a situation where 18% at $8,000, takes place. Now, if this situation is being managed via a credit card, we start off with $8,000. We see here $8,000 is in red. So after 1 month or the first period, we can see here that it moves from $8,000 to $8,089.58. Now we need to look at the minimum balance payment, because that is critical, because you're gonna have the interest for the period, which is calculated here. The first interest is $109.58, and then we have a minimum payment of $20. Now 20 is very, very low. If you were to have something higher, it'd be good. But we have situations where we have a very low minimum payment, and for some it's really, really good, but it creates a situation where you have the debt level increases even faster because of the fact that you are paying such a lower amount initially. Now, so after the first period, we see the debt level increase by $89.58. And by the third period, we move to $8,612.05. So we can see that the debt level is actually increasing significantly by a few $100s by the third period. Then when we look at the sixth period, we see it's $10,470. So yeah, significant sums being added, over 2,000. Nearly 2005 is being added. And by the ninth period, we have 14,000. Yeah, so it's the debt level is increasing significantly, and now this is within the year, so it's not actually a year yet, and the debt level has increased so drastically. Then we get on to the 12th period, and we can see here that the debt level is now $22,468. So this method of financing $8,000 via credit card, paying a minimum balance, as we said before, of $20 for the first period, 22 for the second, the third 24, 26. So we're incrementing by 2 all the way down to 42. And then we have the interest payment, which is 109, and it works all the way down 109 to 22nd period is 223.12, and then the third period is 345.36. we move all the way down to the 12 period of 3,433.73. So we can see here the interest payment of 18%. As the debt level marginally reduces, the level of interest, once aggregated and accumulated over the period, gets into substantial levels, and it is very a huge sum is being accumulated via this method. This is what people are facing in light of the setback with the pandemic, financing their debt level on credit card. And this is a scenario here. These are the calculations, and this is what we can look at. And just after 12 months, we can see the debt levels actually increase, almost doubled it seems, from 8,000 to 22,468. So so it's quite, trades is 24, so we see it's more than, it's going into double what it was. So altogether, instead of paying 8,000, you're actually paying maybe 3 times what you initially took out in debt at the very beginning. And we can see here, this is graphically displayed from 8,000 in 89.58 all the way to about the middle will be about 11,000, 12,000 thereabouts, and then all the way to 22,468.03. So we can see quite a significant amount in terms of the debt trajectory. So it's not one for me, I think, in terms of strategy, but we're going to look at some other scenarios how to manage our financing in light of having to juggle the financial let's say mountain of a challenge in light of reduced earnings, reduced income, and for several months in light of the pandemic. Okay, like, share, subscribe. Thank you.